investing. So thank you so much for joining us. Before we start, I'm extremely excited to let you know that our flagship event, the Big Debate 2021, is live on our website and going virtual for the first time. This high-profile annual event is a key date in the commercial calendar for the start of 2021. On Friday, the 5th of February, we'll be bringing together Norfolk MPs and local business leaders to discuss and debate the issues affecting businesses in the region. This year's topics are Beyond Brexit, People and Skills, Climate Change and Going Green, and Rebuilding the Economy. I'll include in the chat a link to the event page where you can find out more details and book your place. So, everything you want to know about investing but are too afraid to ask. With savings continuing to offer low returns and even talks of negative interest rates, many people are considering dipping their toe into the waters of investing. But for many, this is a world shrouded in mystery and impenetrable jargon, where one question leads to another. In this free to attend 60-minute webinar, Ralph Hunt and Emma Knight, financial consultants at Face to Face Finance, will show you how to take things back to basics, answer common investing conundrums, and allow you to ask all those niggling queries. Following the presentation, there'll be a live Q&A where Ralph and Emma will answer all your questions. So please use the Q&A function when you have a question. And just to let you know, once I hand over, my head is going to go like this, but it's only because I'm chasing the naughty people. I'm not being rude and working and not paying attention. So, Ralph, over to you.
Okay, thank you, and good morning to everyone. My name's Ralph Hunt, and today's seminar, as it says, is that everything you wanted to know about investing but were too afraid to ask. So the agenda for today, and that's better, is...
Sorry, Ralph, to interrupt, you just need to click on share screen.
Oh.
Good start.
And where am I going to find that?
Down your bottom, your green button.
Yep, and when I can't see one. And I don't seem to have a green button, Emma.
Hang on. I'll do mine instead, don't worry, Ralph.
And this went so smoothly in rehearsal.
Always the way. And mine is having issues now too.
If not, do you want to send me over the presentation and I can do the screen share if that's easier?
1 second.
Mark, you are correct. It wouldn't be a webinar without technical issues. And of course, it's on a Monday, but they do say today's Blue Monday. So just bear with us. We will get there. Don't you worry. So I'm going to carry on shouting out people because I missed some. So hi, Sarah from Wellbeing International. Hi, Nigel, Design Communications.
Is that better, Emma? Emma?
Yes, that's working. So if you just go to slide, from beginning. And then if you go display settings, along the top, next one along. Yep. And then click on that and swap presenter view and slideshow. There you go.
Okay, so take two. Everything you wanted to still know about investing, but were still too afraid to ask. So the agenda for today, we're going to tell you a little bit about us. And today's presentation is, if you imagine getting a car ready for a race, and actually in a race to achieve the things that you want to. So we're going to talk about being in the garage, not crashing, and should we use a chauffeur? And the winner is. So first of all, a little bit about myself. I used to work for a company called Acuma. You've probably never heard of Acuma, but it's the financial advice side of American Express. I then went to work for Friends Provident, and finally, since 2003, Face-to-Face Finance. As you can see by my hair, I've got a lot of experience in this industry, and I drive a Mazda 6.
Morning, everyone. So I'm Emma Knights. I've worked in financial services for about 8 years now. I started off my career at Norwich and Peterborough Building Society and was the manager there. After that, I moved on to a place called Moneyfacts. Not many people have heard of it, but it's a financial research company. Everybody thinks it's based in London, but it is based in little old Norwich, so just around the corner. And I joined the team at Face-to-Face Finance in 2018. So I've trained to be an independent financial consultant, and I drive a Renault Capture. So we're completely independent financial advisors, and we're based in Cringleford, and we're directly authorised by the FCA. As Ralph mentioned, we've been a limited company since 2003, and we work with lots of different introducers, so solicitors, accountants, will writers, to help them with their clients and provide them financial advice too. We do also have our own sister company called Face-to-Face Estate Planning. So we can do wills and trusts and lasting powers of attorney. So we can give an end-to-end service for our own clients. But like I say, we can still help other will writers and other introducers with theirs too. So what is it that makes us different to financial advisors? So we don't just wear our slippers when we're at home. Working from home, we actually wear our slippers in the office as well, which has been proven that staff are more productive when they're wearing slippers at work. So we think that's a really good thing to do. We also have our own podcast called Your Recipe for Financial Success. And we're actually finalists in the Podcasting for Business Awards for the Best Education podcast. And the results for that come out at the end of January. So we're looking forward to seeing if we've won that one. We also have a new Facebook group called the Money Compass. So it's people that can join the group. Anyone's welcome to join, and it's just giving little pieces of information and guiding you to basically navigate your own way through your finances. We have a director of happiness, which is the little teddy bear there, Eddie Teddy. Eddie has written 2 books. He launched his second one last year, and he is basically helping us to educate children about finances too. So there's lots of things there about us, but something that's really important that clients never really realise is that we never technically go on holiday in our clients' eyes. If a client were to phone us up and say, can I speak to Ralph? I really need to speak to him about X, Y, and Z. And if Ralph was on holiday, Ralph would get sent a message and he would always call that client back from wherever we are in the world within 24 hours, which is a really good service to be able to offer our clients. So it's something we're really proud of.
Okay, so financial advice. We have existing clients. Some of those have been with us getting on for 30 years now. And we come across new clients. And new clients, a lot of the time, tend to say the same things. My advisor said that I would get X amount in return, and I haven't. Pensions, they're just rubbish. They're no good. I've had one for years and it's not done anything. Or I've never seen my advisor since I set up my investment. And my friend said that they had an investment and they lost lots of money. So during this presentation, we want to show why this could have possibly happened, and also how you can make sure that this doesn't happen to you. Priorities. Now, we could have talked about goals, but I think priorities are possibly a better word. The reason for that is this. Many people want to do different things. Some people want a new car, or they want to upgrade their car. Some people want a bigger house, or they want to be able to pay off their mortgage. And some people want a good retirement. We didn't bother putting any pictures for retirement because that really is very much an individually driven thing. I could have put someone playing golf. I never play golf. Someone sitting by a swimming pool, all sorts of things, but it really is yours. So if you imagine having priorities, well, you would possibly need a budget, because if you haven't made sure that you're going to achieve those things that you want to, you're going to need some money. And I always think that there's two types of budgets. There's what I call the easy budget, or incorrect budget. The incorrect budget is, I earn £1,000 and my outgoings are £800, so I must have £200 that I can spend. And then there's what's called the correct budget. And the correct budget really is, what are the necessities? What are the important parts of your budget? Now, that could be life cover, that could be mortgage payments, food. They're pretty important things. But spending money at Costa and going out for meals on a constant basis, having the latest telephone, they're really choices, more lifestyle, and can impact your budget. The reason why this is important is because priorities and budget actually have a knock-on effect. And they have a knock-on effect later. You never see the problems that they cause now, but you certainly see them later. So I'm now going to introduce Sydney. Now, Sydney, he could be a gentleman who got his priorities right, got his budget right, and got his retirement right. And he's actually working in B&Q because, quite simply, he really enjoys it. We know plenty of people that never want to retire in the traditional sense. They like working. They don't mind doing a couple of days a week. Or Sydney could have got everything wrong. He could have got his priorities wrong. He could have got his budgeting wrong. And he certainly could have got his retirement wrong. And he could be working because he has to. Every now and again, I come across clients who say, well, I'm okay, really, because I have the bank of mum and dad. They don't call it that, but they'll say, well, you know, I'm okay. When mum and dad goes, they've, you know, I know I'm going to get that, or I'm going to get half of it with my brother or sister. Now, the problem is that it doesn't always happen that way now. In the olden days, if you looked at life cycles, people worked for many years, they retired for a few years, and then they died. But nowadays, people are living longer, and you'll certainly see that with examples coming up. But many people now go into care. And if they go into care, we know that generally speaking, most people end up paying for their care. And if they go into care, they can possibly pay inheritance tax. So there's people who may get at your money before you do. So that's why we don't like to rely on the bank of mum and dad. So how do you make money?
So there's three things that will ultimately make you money. The first one is time. So if you really wanted to make your child a millionaire without having to leave them a single penny when anything happens to you, what you could do is invest in a pension for them. So imagine you invested £3,600 a year into a pension for your child from when they're born for the first 10 years of their life. So with tax relief, all you'd pay in yourself is £28,800. If they were to get an average return of 7%, once they reach the age of 55, when they reach their retirement age, they'd have over £1 million in that pension pot from you putting in just under £30,000 in the first 10 years of their life. So having loads of time on your side is really going to help you to achieve growth because you've got the time scale to be able to achieve it. Another thing that will make you money is money. So everybody's heard of the saying, money makes money. It's quite true in the world of investing. So if you came to us with £1 million and said, I'd like an income of £10,000 a year, that's going to be really achievable. 1% income, fine. If you came to us and said, I've got £1 million, but I'm looking for an income of £100,000 a year, not necessarily impossible still, but obviously it's going to be a much higher return that you're looking for from that capital. So another thing that affects both of those really is risk. If you don't want to take any risk with your money, you may as well have it in a bank account. And we all know what the interest rates are like at the moment in bank accounts. You're getting pennies basically. And even that isn't completely safe because there's the risk of inflation. So inflation being higher than the interest rate, you're technically losing money. And places in Europe, Denmark, and we've heard it in the news that it could come here soon enough, negative interest rates. One day we could be paying to keep our money in a bank account. So what we do is we would help clients to understand risk and educate them and find a balance between the time, money, and risk. So a question that lots of clients ask when they come to us is, can I lose all of my money? And we would give every client the same response pretty much, is for you to lose all of your money, the world would basically need to have ended. When you consider that you're going to be invested in things like Coca-Cola, BT, Apple, Shell, the UK government, all of those would have had to cease trading for you to lose all of your money. So to help us establish with our clients what their level of risk is and what level of risk they'd be prepared to take, what we tend to do is use a risk questionnaire. So hopefully Kayleen has our first poll question for us today. So I just want you to go with your gut on this. Don't spend too long thinking about it. So if you had money to invest, how much would you be willing to place in investment with possible high returns, but an equal element of risk? All of it, more than half, half, less than half, or none? So I'll just give you a few seconds to answer that. Quite interesting, we've got a good mix going on there. But I'd say the majority there are going to go half or less than half. And to be honest, that's not an unusual thing for anybody to say. And it is quite a normal thing for our clients to say. But over time, so there we go, the winner is half. Over time, our clients start to understand risk and what it means and how it's going to impact their priorities. And sometimes over a period of time, that level of risk they're prepared to take is going to change. So hopefully I can get rid of this poll. There we go. So the next thing we look at after we've looked at those three things is what vehicle are we actually going to use for this race? So there's different things that we can use to invest in, whether it be an ISA, a pension, a bond, a life assurance bond, a general investment. There's lots of different investment vehicles that we can actually use. And it's going to depend on your priorities and your what level of tax you pay as to what vehicle is going to be the most appropriate one for your race. So hopefully Ralph is going to tell us a little bit more about the race now.
Okay, so we've worked out about the risk. We've got the budget. We know which vehicle you're in. But which road are you going to take with your investment? So a higher risk person would tend to go with more what we call equities or shares. They give generally speaking, the better returns over longer periods. We also look at commercial property, fixed interest. And fixed interest isn't banks or building societies, it's government debt, UK government debt and the world. And it's also companies who want to borrow money. To give you an example, the biggest corporate debt in history is Apple. Apple came to the market and said, and this was from a tax point of view. Apple is a super rich company. They've got over 200 billion in their bank accounts, but it was better for them to borrow money. So they came to the market, they said, we want to borrow $15 billion over a 5-year period, and we will pay X. And basically the AAA company, the markets, were quite happy to pay that. So Apple actually pay less in interest than Greece does. As you can see, there's one with other, and other can be anything from gold pretty much to any other investment that you want. And you would either invest in one of those particular areas, or generally speaking, a proportion of your money would be in each. One of the areas that wasn't on that road was cash, and why bother using cash? Well, we always recommend cash for an emergency fund. And we also recommend cash for very much short-term priorities. But that really is it. Cash is not an investment. If you have a long-term priority, you do not use cash. And here's an example coming up, and this is over the last 12 months. This is using our own in-house model portfolios that we run ourselves. And for example, £100,000 in cash would have returned you around about £200. Our lowest risk portfolio, which we call cautious, would have returned just shy of 16%. And our risk 7, the one with the most equities in it, would have given you a return again just shy of 25%. But as you can see that line, you can see that in March, the fund performance was down. And Emma said that we had around about 5 clients who was actually concerned about that, and 3 actually invested more money from a conversation with myself. But the market at the lowest period, which was the 23rd of March, the FTSE 100 was down 36%, and a risk 5 portfolio, so that's 1 over average, was down 18. It doesn't help. But one of the biggest things that someone can do if the markets are down is do nothing. So we've got the car. We're almost at the point to go on the race, but we need some safety checks. And the safety checks for us would be to make sure that a client has got an emergency fund. If a client has debts or dependents, or death duties to make sure that they have life cover, and possibly added critical illness cover as well. If they've got a job, to make sure that they've got income protection, protecting them for a long-term illness. Income protection will allow them to get paid up to 70% of their normal income all the way through until their retirement. And equally important, to make sure that they have both wills and lasting powers of attorney in place. So we're off, we're ready for the race.
So everything we looked at so far is the preparation for the race, getting onto the road, out of the garage, and here we are. But we all know that no journey is ever smooth. There's always potholes in the road along the way, and there's lots of different things that we might encounter in the world of investing along the way. So the first one we think about is your priorities again. Now, your priorities may have to change, and it might be by choice that you've actually just decided that that's no longer your priority, you've got something more important now, or it could be that your circumstances may have changed. So it could be that you've progressed up the career ladder faster than you expected to, or complete disaster that you've been made redundant, you've lost your job, and so many people have this year that it does just happen. It could be a new arrival in the family, it may be a child, a grandchild. We all know children cost a fortune, so that would change our circumstances massively. And like Ralph mentioned, you could be off sick from work, unable to go back to work for a long period of time, which is all going to have an impact on those priorities. So having done our safety checks when we first leave the garage is really important to make sure that obviously we stop as many of these problems arising along the way, but we can't always stop them all. Another pothole is inflation. So I mentioned earlier about how to make your child a millionaire by the time they reach retirement. The thing we also need to consider is that £1 million, say today, is that going to have the same buying power by the time they reach retirement? Probably not. So that's why taking the inflation into account is a really important thing to do. So as we've been looking at cars and a race, I thought I'd just give you an example of a car. If you were to have bought a car in 1960, so the average price in 1960 of a car was £800. In today's money, that car would cost £16,800. But cars we know are quite a lot more expensive than that now, a brand new car. And the average price car today is actually 21% higher than that of the car back in 1960. So the cars would obviously be a million miles apart. Technology has advanced massively since then, and we have all of the mod cons that we do now, which is obviously why the price of a car has inflated more so than inflation. But it just shows that the real cost can accelerate a lot faster than what inflation does. Another big pothole that we'll have seen in the last year is world events, things that we have no control over whatsoever. So we had the tech bubble in 2000, the financial crisis in 2008, which is still the worst one kind of in our lifetime, and COVID-19. So last year, but we're still feeling the impacts of it this year. As you know, we're all still working from home. You can see us here now. So it's still having an impact on us personally and on our investments. So as Ralph mentioned earlier, the 26th of March was the lowest point of the FTSE 100. It was down 36%. Our risk 5 was only down the 18%. So as Ralph said, we had a few clients phone up, but not too many. So I've got our second poll question for you today. So imagine that 6 months after making an investment, that the financial market started to perform badly. In line with this, your own investment goes down by a significant amount. What would your reaction be? Withdraw all of your money and put it into cash in a bank account. Transfer your money into a slightly safer investment. Monitor your investment, or invest more. Now, I'm really glad that those two seem to be pinging up more than the rest, because that's a good sign. So fantastic. So about 50-50. Some of you are saying monitor it, some of you are saying to invest more. So finish there exactly 50-50. And we have the occasional client that worries. So of 1,500 clients in March last year, we had 5 clients call us. And of those 5 clients, as Ralph mentioned earlier, only 2 of them paid in some more money, and the other 3 monitored it, which is exactly what we would tell every client to do. If they phoned us up concerned about what was going to happen to their investment, we would say monitor it, or if you can afford to invest more, now's a really good time because the markets are low. So I'm glad you all understand that's a good time to invest as well from how you've answered the poll today.
So, why use a financial advisor? If you remember going back to the points I made earlier, my financial advisor said I would get this amount. Pensions are rubbish. People I know have lost loads of money, that sort of thing. Well, generally speaking, as a financial advisor and as an industry, we actually make people money. We make people more money than if they did it themselves. Combined benefits over a 10-year period is 2,400% more than the initial cost of advice. Following financial advice, the average less well-off saver had their pension pot boosted over a decade by 24%, or £35,000. Those who had taken additional advice were found to be an average of 61% better off overall. This is why people tend to stick with their advisors. So how do we work with clients? Well, we look at priorities, we look at budgets to make sure, and we let people know what they're doing. It's the consequences of actions. A client of mine once said, well, you know, I would like to retire on this date and that date. But they also like to have new cars, and they like to have new cars every 3 or 4 years. But by doing that, that was actually making them poorer in retirement. And by looking at their car situation, we were able to allow them or make them financially better off so they could actually retire earlier. And one of the ways we do this is by using what we call cash flow analysis.
So I've done a little example here, and I've used myself in the cash flow analysis that I've run to give you an idea of kind of what it can show. So I'm 27, and in this example, I'm going to pretend that I've got no pension provision at all. The state retirement age for me is 68 years old, and state pension at the moment under the current legislation is £175.20 a year. Oh, a year, that would be awful. A week, sorry. And as Ralph mentioned earlier, longevity is a really big thing now. People are living a lot longer. So I use the Office of National Statistics, and it shows that my 1 in 4 chance of living to the age of 97. So people that say, oh, I'm not going to make it to 80, I'm not going to make it. Mine's 97. And that age is going to increase as medical technology improves and all those sorts of things. So it's a long time. So my pension is basically going to need to provide me with an income for about 30 years. So if I look at having an income of £1,500 per month in today's terms in retirement, I would be needing to pay into my pension £220.80 net each month from now until I reach state retirement age. So with tax relief, that's £276 gross. And that's for another 41 years I'd need to pay that in for. If I wanted to achieve that £1,500 a month and have the state pension in addition to that £1,500, I'd be needing to pay in £446.40, or with tax relief, £557 a month. Now, most people are probably sitting here thinking, that's a huge amount of money. How on earth can anybody afford to be able to do that? So this is used quite a low rate of return, about just over 2% a year. Now, this is where the three things I talked about earlier are going to come into play: time, money, and risk. For me to be able to achieve that, it's probably important for me to increase my risk to improve the return that I'm likely to achieve. And that's what's going to mean that I'm going to end up having to pay less into my pension to achieve that income in retirement I'm looking for.
Whenever we look at a vehicle for a client, one of the things that we have to do as financial advisors is tell them the benefits, but also any of the drawbacks of that investment. And if you imagine actually going to buy a car and this happens, and this is my Mazda 6. My Mazda 6 actually has heated seats. In fact, it has cooling seats as well for the summer. It has a Bose audio system, and it has mood lighting if I can ever find the switch to put my mood lighting on. It has automatic headlights, so if I don't dazzle anyone. It has lane departure that shouts at me if I try to change lanes. It has parking sensors and cameras and all sorts of gizmos, and it's not because I can't park. Well, actually, I can't park, but that's beside the point. It has shiny metallic paint, 0% finance, and a low deposit. So there I am, champing at the bit. I want my shiny Mazda. Imagine if the salesperson actually carried on the conversation and said, well, you do realize, I know you do quite a few miles, Ralph, in the normal world. So we're going to be seeing a lot of your car because you need a service every 12,500 miles. And obviously that will come as a cost. Because you've got a newer car now, your insurance is going to go up and you're going to need to tax it. And if you keep it longer than 3 years, you're going to have an MOT. The big advantages of this car is the minute that you drive it off the forecourt, you're going to lose 20% of the value because of the VAT that we've added on. And but don't worry too much about the value, because I can assure you that will drop like a stone over the next few years. That shiny metallic paint, yeah, that isn't going to be that shiny once you start driving it up and down the roads. It will look like a Pebble Dash bungalow by the end of 12 months. And when you come back with your battered, high mileage car with the cooled seats that you particularly like, we're going to offer you £1 part exchange for your new one. Someone who's buying a car, if they're hit with that, might think, is this the right car? Now, it could still well be the right car because it is shiny and nice and needed. But with us as advisors, we will give you the benefits and any drawbacks of anything you do. And we think it's important because it goes again back to those messages. My advisor didn't tell me this or didn't tell me that. Well, we do. So what we also talk about with clients is what we call good debt and bad debt. Now, first of all, we're going to look at good debt. Well, good debt at the moment are mortgages. They're quite low rates for everyone, or very low rates. They can be affordable. And they're predictable because you can actually fix them for periods. What is bad debt? Well, bad debt is credit cards, payday loans, anything with high interest rates, compounding, or a possible variable rate that goes from a low rate to a high rate after a certain period. So I'm now going to give you a true example of some clients of mine. And I've called them Janet and John. And Janet, unfortunately, was diagnosed with cancer. And because we'd done her safety checks, she was paid out an amount of money. And I went out to see her. And the great thing about Janet is that she's now clear of cancer. But the conversation I had with them went a bit like this. They had this lump of money and they were going to pay their mortgage off. And one of the questions that most financial advisors will ask is why? Because it elicits answers. So I just said, why are you going to pay it off? And they said, well, you know, we took it out to cover the mortgage. We've got it and we're going to pay it off. And I asked them whether they could afford the mortgage. Yes. Was there any way of paying off the mortgage without this money? No. So unless the horrible event had happened, you'd have just carried on as you were. Yes. And then I flicked the conversation around the other way. And I said, well, for you to get this lump of money that you've got, how long would it take you to save? And they said, well, it would take years. So what we did, with their obviously agreement and their understanding, is that we invested the money in the correct vehicles, and we used ISAs and what we call a general investment, because they had more than 40,000. You can only put 20,000 into an ISA, as most of you probably know. But this was the tactic. If we made money on that investment, and most years you will, as most people do in their investments, we would skim the money off the top, and then we would actually pay down the mortgage. And that meant that the mortgage would finish earlier because they'd also carry on paying their mortgage at the same rate, but they'd still have this pot of money. So eventually they'd have no mortgage, but also this pot of money that could then start growing again. And the reason why we use this route is because A, that money would be there for them in an emergency. Yes, the markets could have moved it up or down, but not a huge amount with the risk that they were taking. And when you go to save money to build up an investment pot, you have to make sure it's a priority. Too often people go, well, I've got this extra £300 and they'll pay it in for 3 or 4 months and then go, well, actually, I think I'm paying in a bit too much. It's because they didn't get the budgeting right. Or something will happen. Well, I'm just going to reduce that because we want to save for a holiday. But it does have a knock-on effect. And as you can see from our returns, our model portfolios, they're going to have, they've had growth in the past that's already reduced their mortgage, and they've got growth this year that will reduce their mortgage. It's as simple as that. But sometimes it's thinking outside the box, and that's what an advisor can do. What do we give clients? We tend to give them peace of mind. They know that they can contact us anytime through either an email or a telephone call. They also get reviews. As a company, we're not interested in transactional work. We don't want someone to come to us and say, can you look at my pension? I'll pay you a fee, but I don't want to use you or have anything to do that. We know it's not very good for the client, and it's not the way we operate as a company. We look for long-term relationships because we know long-term it actually benefits us, and it also, more importantly, benefits the client. You've seen the fund performance. That didn't happen by accident. It's because we run our own portfolios, and in our pit stop for our funds, if any of them were underperforming, quite simply, we would actually change the fund. So that means that our clients win. They actually get to where they want to go to. They don't have pensions are rubbish, because pensions aren't rubbish. Generally speaking, it will be the underlying funds. My advisor, well, we see our clients every year, sometimes every 6 months. We can see them for year on year to make sure that they get there. And there isn't a surprise. My client said I'd get £1 billion and I've only got this much. Well, that's a transactional charge. That's not ongoing service. So I would like to thank you for listening in. I'm very sorry about the glitches. As you can see, we don't get paid for our expertise on presentations. I'll also apologise to Emma because I stole some of her thunder by answering earlier. She's now laughing. So if you've got any questions, please ask.
Thank you so much, and I love that you all wear slippers in the office. This makes me very happy. So if you've got any questions, feel free to pop them in the Q&A, pop them in the chat, or you can virtually raise your hand and you can verbally ask your questions. We don't mind. I appreciate that this is a virtual event, so it'll take you a little while to type questions out. So while we'll wait, I've got a question. So Emma, I know you mentioned about maybe negative interest rates will come over to the UK. If they do, how would you recommend people deal / manage negative interest rates?
So negative interest rates obviously isn't going to be a good place to have your savings. So if you've got a huge amount sat in a bank, it's not going to be an ideal place to leave it sat there because you're going to be paying to keep it there. So as Ralph mentioned, having it just an emergency fund there and money that you need in the short term, that's what you should be using the bank account for. And any other, obviously looking at your options for investing it, and it can be lower risk, so obviously it is going to reduce the volatility. The good news with lower interest rates or negative interest rates is we could also then see negative mortgage rates that they have in Denmark too, where say you take out a mortgage for £100,000, at the end of the term you'll have only ended up paying back say £98,000. So you're getting paid to buy your own house technically. So that there's benefits to it as well that we could see. So
thank you. So we've got Sarah says, is an initial consultation free of charge?
Yes, it is.
Perfect. Nigel, can you deal with pensions, company owners, etc., i.e., how broad is the expertise and how do you know an IFA's skill set could be a one-in-a-lifetime decision?
As a company, we deal with a lot of managing directors and a lot of company pensions and individual pensions. The skill set is almost having a conversation, and it is difficult because the qualifications, you can have someone who's literally left college, is a chartered financial advisor, but has actually never seen a client. It's really having a conversation because you need to feel as though your advisor is part of your team. And you need to think of this. I always say to new clients, you need to imagine me coming to see you every 6 months or every 12 months. are you going to be happy with that? You need to be honest with yourself. If you don't like the cut of my jib, do not have me as a financial advisor, because it's someone who you've got to work with, who you've got to say things to, tell people information that you don't always even tell members of your family.
Thank you. Hang on. So Nigel then says, but you can't speak to loads of advisors, need some sort of ability to filter?
No, you can't. Well, ask friends if they what they like. We get lots of referrals from our existing clients. You also need to understand what independents mean against whole of market, because even within Norwich, there's not a huge, although it's a major place for financial advisors, there's not a whole heap of truly independent financial advisors. And the other thing is that you have to remember that financial advisors are a bit like modern day Thatchers. There isn't a great deal of us left, and the average age of a financial advisor is 61. Hence the reason why we have Emma here, who's going to be eventually our future, and people like Emma. But how would you filter advisors? I don't know. How would you filter solicitors, accountants, plumbers, and anything? You would normally speak to someone or chat to someone. Generally speaking, to be an advisor, you're going to have qualifications, and you can generally tell if they know what they're talking about or have got the experience.
Thank you. I'm going to ask this question, but let me know if it's suitable or not. So Mark says, I'm closing on retirement. Do you have any advice on what Aviva seems to call lifestyling?
Yes, lifestyling, I have to say, tends to be a little bit old school. The reason being is that we tend not to do lifestyling to a great deal with our own clients because we see people on a regular basis. Lifestyling tends to be, you've got a pension with us, you don't see anything, so we reduce the risk as you get closer to retirement. But the problem with that is that a lot of people are going into what we call drawdown now, which means they don't buy a traditional annuity. And I don't want to get too technical, but give you Emma as an example. If she was retiring at 68, she could possibly live to 97. That's 30 years. That's 30 years of investing. So you need to understand the consequences of that, how much money you want out of it. And it goes back to what Emma said about risk and return and ongoing service. We always think of face-to-face finance is the most important part of the service that someone gets, is not just getting them to retirement, it's actually working with them through retirement and into retirement, because it's quite a scary thing. If you make the wrong decision, imagine in March 2020, you're on your own, you haven't got a financial advisor, everything looks as though it's falling. What do? You panic, you phone up the company you're with, and you write to them or whatever, however you contact, and you say, please move all my money into cash. I need to save my money. And then the markets go up, you've lost a huge amount of money. So this is why people use us. And it may be a long-winded answer, but lifestyling tends to be used for people who don't have advisors.
Thank you. So Sarah says, how many advisors work for face-to-face finance?
Well, I know Julie would probably say about half of them, but that is a very old joke. We have 3 financial advisors.
Perfect, thank you. And Nigel says, if you wanted a 40k PA income age 65, what pension pot would you need?
Yeah, I thought we would get a question like this. It's and I'm now trying to pull my piece of string. It depends on the percentage of the income that you wanted to take down. So if you imagine 40,000 and you wanted and you were happy and it was correct for you to take a 3% income. So, you know, you would need a pension pot of about 1.3 million. So that would be it. So it depends on your situation, your health situation, what it is you wanted to do. We have some clients that want to safeguard their pension because it's good for inheritance tax and things, and to pass that on. And there's other clients who just say, no, you know, in my 1 in 4 age, I literally want to end up with a penny there. And that would be the difference. But people do need plenty of money. If you want a £40,000 pension purely coming from a pension pot, you need some money. And going back to what Emma said, it's down to time, money, and risk, and understanding risk.
Perfect. Thank you so much. Just conscious of time, so thank you. You've answered all the questions. I have popped in the chat function just a quick link to the survey, just to help us to develop our virtual offering. I also wanted to let you know that I will be sharing a copy of this presentation with you, so feel free, you can get in touch with Emma and Ralph if you have any other questions. I'm also pleased to let you know that they will be returning to present another webinar with us on Monday the 22nd of February. So it will be PIPSI, 5 steps to planning your finances. So I'll include a link to that in the post-event email as well, along with a copy of the presentation. So it's just to say thank you so much for joining us this morning. I know I've learned so much, so I hope you've taken a lot away with you as well. So yeah, just wanted to see, Emma and Ralph, if you had a final farewell before we shut this session down.
Yeah, just one quick point about finding an advisor. There's unbiased, and there's also the FCA register. Obviously, I haven't looked at either of them, but there are, you know, a couple of tracks if you wanted to go down to. But you're really going to end up speaking to someone anyway, I would have thought.
Thank you. Emma, did you want a final farewell?
Just thank you very much for listening in today. Our links are on there as well to our Facebook groups as well. And if you did want to listen to our podcast, it is on iTunes and Spotify, all the usual places.
Perfect. Emma, if you wanted, or Julie, I think she's still on the call meeting, whatever you want to call it. If you want to share the links with me, again, I can include that in the post-event email as well. So yeah, thank you so much for joining, and hopefully we'll see you again soon. Bye, everyone.
Thank you.
Thank you. Bye.
Bye-bye. Bye-bye.